All right. So today I'm going to do something. Well, I'll tell you what today is going to be about. I'm going to give you a presentation that I did to a live group about a week ago. And I was just going to get the recording and post it, but I thought that this might actually be more useful because this is just going directly to the private Facebook group, likely on YouTube, and then on my podcast channel. So this is, where's my notes here? Investing in commercial real estate. And I'm going to talk to you about the $11 million industrial development deal that I completed probably in 2019, 2018. I can't recall the year right now for some reason, but it was within the last 2 years. All right. And so with that being said, I want to get a few things maybe just covered off first. And the first is that I'm just going to share with you what is working for me and what I have seen work for other commercial real estate investors in Canada. Okay, I'm not suggesting it's the best way or the only way to invest. The reason I invest in commercial real estate is because I have a competitive advantage. And in my experience, it's not very well understood from outsiders. So my hope is that today I can share with you a few insights into the world of commercial real estate investing. So that's really my main objective. And with that said, let me flip over. Hopefully this is going to work. Okay, that looks like it's working. And let's just go to present mode. I don't know how this is. It's kind of weird. Anyways, let's just run with it. So investing in commercial real estate and the $11 million development. So just a quick disclaimer. I want to kind of emphasize the fact that this is not any investing or financial advice. I'm not pitching you any of my deals. This is just really to show you, one, an industrial development from start to finish, so you can kind of see how that laid out. And then two, I'll show a townhouse development that I'm working on currently, just so you can kind of see the process and how I'm thinking about things. All right. So I'm not sure exactly what you guys see. Here is the agenda, if you will. All right. So why I invest in commercial real estate and why I don't think it's actually for everybody. The risks and lessons learned. Number three is the industrial development, the townhouse development. And then I don't know if we're going to get into Q&A because even though this is live, I don't have Facebook up because it would be too distracting right now. So here are a couple of the reasons why I like commercial real estate. Okay. Number one, it's valued on NOI or net operating income. Number two, I can force the value of a property by raising the NOI, right? And the NOI is really just your gross income minus your expenses equals your NOI or net operating income. I like the scale, right? Where one commercial property has the ability to replace a six-figure income. And the other thing that I really like about it is the fact that it is an inefficient market, which means there are arbitrage opportunities for insiders with knowledge. Okay. Now, my business model, if you will, is really like, and I was just talking to a business partner of mine yesterday, and I'm not going to give you all the details because it's not important, but I essentially said, like, in every deal, I have to justify my existence, and usually that means finding properties that I can add value, generally raising capital, and then developing or fixing a problem. Okay, so that is kind of my philosophy, if you will, on syndicating commercial real estate. You don't need to be a syndicator, right? But if you're investing with someone that is syndicating, that would be maybe something to consider. So what am I looking for when I'm finding properties? A few of the things. Number one, I'm looking for vacancy. I'm looking for below market rents. I'm looking for properties that are poorly managed. I'm looking for redevelopment or expansion opportunities. I'm also looking for underutilized land and buildings and unmet demand. Okay. Now, if you don't know my backstory, I'll condense it in as short a period as possible. So when I was 18, I saw my parents lose about $100,000. I say about because it was I think $75,000 US, which was maybe a little bit more than $100,000 Canadian. And this was back when I was 18. So that event, and I actually personally lost, I think it was $13,500 in that deal as well. But when you're 18, you can bounce back. I mean, it sucked, but for my parents, that was essentially 10 years of savings because they refinanced their house and it took them about that long to pay it off again, right? They're both teachers. It's not like they have the ability to go out and generate $100,000 to just pay off that loss. So after that event, if you will, it kind of set me on a path or a journey to really start to understand investing. And it led me down, once I got out of university, to real estate investing. And I started off at the city of Calgary, first in assessment, then urban planning. Then I went to Sun Life. And once I was at Sun Life, it's where I met my now wife and my father-in-law. And they are a publicly traded company that has both developed and owned real estate for 98 plus years. Okay, so that's kind of a little bit of the backstory, if you will. And one of the things that I think, even though these 4 questions may seem very simple and basic, most investors, when I'm talking to them, I don't know if they actually have these at the forefront of their mind. Okay, so I'm going to tell them to you, and they're very simple, and it's actually like what I learned in CCIM 101, which is kind of like if you're a commercial real estate developer or broker, this is kind of like the PhD of commercial real estate. CCIM, can't even remember what it stands for right now. It's like, yeah, anyways. So number 1 is how much money goes in. Number 2, when does it go in? Number 3, how much money comes out? And number 4, when does the money come out? And I have seen so many pitch decks and pro formas where these numbers or these questions are not answered. And I can tell you, when you're dealing with high net worth investors, they are hypersensitive to getting these questions answered. Now, I'm going to give you a couple of lessons that I've learned from my mentors. Okay, now these are not, there's obviously a lot more that you can take away, but I think that these 7 are some of the biggest lessons, and they are more principles, if you will. And the first is the sponsor. And often what you will see with sophisticated investors is they're betting on the jockey in terms of who are they investing with. And that usually comes down to what is their track record. Number 2 is like, who is the team, right? So you might have a sponsor, but who underneath that sponsor is going to execute on the plan? And have they worked together? Have they done this type of project in the past? Number 3 is debt. So what is the loan to value? What's the debt coverage ratio, or the DCR, or debt DSCR, the debt service coverage ratio? It essentially means the same thing. And what is the holding power of the GP? So what I mean by that is, oftentimes when you get into a commercial project, if things don't go as planned, can the general partner, are they going to stick it out to see that deal be a success? I want to make sure that I'm still, hold on a second here. Let me just see if this is still recording. It is. Okay, perfect. There's actually someone watching too. Okay, let's get back into it. So here are, let's get back into the present mode. So sponsor, the team, the debt, the pro forma. So what are the assumptions, right? This is where having a second set of eyes from an expert, I think, is very important, because one of the things that I've realized as you are both an investor, a broker, when you wear different hats, right? When I was a lender, as a lender, you're hyper conservative. You stress test and you look at all the different sensitivities of a pro forma. As a broker, you might run those sensitivities, but you're probably more optimistic, right? Because you have told, let's say, an owner or a developer that you're going to get them the maximum price. And so to do that, you're usually pushing the envelope. There's nothing wrong with that. It's just depending on who is putting that pro forma together, just appreciate what their motivations are. As a lender, I'm stress testing it because I don't want to lose money. All right. And so the reason I tell you that is it is actually very easy to financially engineer a pro forma by just tweaking a few things: rents, vacancy, growth rates, cap rates. I mean, all these things, especially when you amplify it, you change 3 or 4 different variables inside of a model, and it can have huge impacts on the entire outcome. The fifth is, what is the market? Are you in a growing or dying market? I think it's pretty self-explanatory. The property itself, what's the physical condition? I remember walking a $16 million property 2 weeks before closing with our general contractor. We found a significant issue, and we actually had to walk away from the deal. Obviously not something that you want to do, and you definitely don't want to be in the practice of that. However, inviting the general contractor, even though we had a building condition report, we had the environmental, we had everything taken care of, that likely saved us multiple 7 figures. And I mean, we probably, unfortunately, because we had probably spent close to $30,000 in due diligence, but those are the risks and rewards, right? So I think it's important just to understand both sides of the coin. And then the legal docs. And really what I'm looking for here, if you're an active or a passive investor, is how are decisions made, right? What are the voting rights? What are the cash call provisions in terms of how can you get diluted? And what is the waterfall? The waterfall is really how are limited partners and general partners compensated, right? And inside of that, you'll see fees and whatnot. So those would be kind of the 7 lessons that I think would be the most relevant to both active and passive investors. Okay, now this is a question that I got from listening to and studying Sam Zell. I think his book is Am I Being Too Subtle? He's just a very interesting and extremely successful and savvy commercial real estate developer and investor. And the question that he asks is, I don't know why it keeps skipping here. I think there's just a delay on my computer. What core assumption are you making that needs to be true for this investment to be a success? And I think when you really get down to these questions, you are going to see, I'm going to show you some of the deals I've done, even in addition to the industrial development, but you'll start to see a trend. And I want to give you that trend right now. Maybe you'll see it, but I will obviously highlight it and explain the key assumption in 90% of the cases as it relates to commercial real estate. Okay, so I'm not sure. Yeah, there's just a bit of a delay. So in terms of some of the previous deals and some of the lessons, this was an 1,152 or 1,153 acre. So there were 2 resorts, and they were a land lease community. And the key assumption in this was that we went into it was that these cottages sell themselves, right? We toured the competition. We saw what they were doing, running full-page newspaper ads in the Toronto Sun and the Toronto Star that were costing from $10,000 to $15,000 a week. They would get, call it 100 people to the resort, and they would sell 10 cottages that in a week. And so we thought, okay, this is simple. Well, the reality is that it's not simple. It's easy to get people there. It's not so easy to get sales. And when you're selling this type of a product, which was unique, you really had to build out a sales team. And so this took us a couple of years to really refine. And we were for about 3 years straight, we were spending about $250,000 a year on running ads. We did like a documentary. We did online, offline, trade shows, you name it. Everything we could to get people to the resort, to build trust and sell these cottages, okay? Another one here is this retail project right here in the middle. This is the one we're going to talk about here shortly, the industrial one. But this retail project, the core assumption was that we would get an anchor tenant and they would bring in the balance of the tenants. The truth was that when COVID hit, it changed the way that retail tenants were, A, looking at retail properties, and B, as a landlord, you're starting to question, do you want this type of a retail tenant in there? And, you know, obviously with the growth of e-commerce and Amazon, these all impacted the retail project. And, you know, as of December 21st, we did lease up our last space. However, it took longer and, you know, we had to reconfigure the design. This building right here, we never even actually built this. We actually had to build a lube shop. And then this building here, which was about 10,000 feet, ended up being about 5,600 feet. This was kind of an interesting one. So we bought a portfolio of mortgages in Eastern Canada. And what was interesting is the assumption that we went into this particular deal was this was a major bank. This is going back into, I think it was 2009. And there was a bank that was doing they had told us about $250 million a month in mortgages. And my assumption was that a bank that is that active, like I knew when I was at Sun Life, I knew how diligent we were. Like, I mean, it would take us 3 months to do a specific loan. However, these loans, as you can see just from some of the pictures, they were like tiny little properties, anywhere from like $750,000 up to $3 million. And when I was at Sun Life, like a small deal would be $10 or $20 million. So the reality was that the bank had not toured any of these properties. They relied on third-party reports for all their due diligence. And so my father-in-law, Andy, and I, we'd gotten a plane and a car, and we drove around and looked at, you know, of the 58, we basically eliminated, I think, any properties in Manitoba and Saskatchewan, just because they, you know, we would have got to them. However, we just said, look, we've only got so much time. So we hit the Alberta, BC, then we flew out to Halifax, and we drove all the way into Ontario over kind of like I said, about a 3-week to 1 month period, and looked at all these loans. And of the 58, we chose 7. So 3 went into foreclosure. We worked out every one. It took us a long time. It was a lot of work. And the reality is that this deal would have been great if there was an extra 0. Okay. So the project size you can see here was 3.2 million. If this was 32 million, it would have been worth the effort. However, on every one of these properties, you learn a lot. And so it was very good for our investors and for ourselves as general partners. But I'm just sharing with you some of the lessons that you can kind of take away. So I won't talk about this one here. I'm not even going to talk about some of these projects here, but some of these are multifamily. I'll talk about this one first. So this was like one of the first Class A multifamily that I helped my in-laws acquire in the US in 2009, I think it was. And the reality is the broker told us this was one of 5 Class A multifamily properties to trade in 2009. And the reality is when there's very little competition, you get to set the terms and the price. Fast forward to today, this property would, I believe we were in the mid 80s. I don't know why this thing keeps switching around. A door, and this asset today would be 175 to maybe 200 because of its location, the rents, the cap rate compression. And so, and it would have multiple offers, right? It would be literally impossible, not impossible, but you would really have to stretch to get an asset like this today. All right. So I'm not going to get into those. We'll just jump right into the industrial warehouse. This is the, this was 3 industrial buildings. You can see them all right here in this picture. And it was about 36,000 square feet. It was 16 months, and it was approximately 34% ROI to our investors. Okay. So here is kind of the deep dive that we're going to go into. Now, the assumption that our brokers gave us was that you build it and they will come, right? Like the field of dreams, you know, and that's, I think that's kind of you know, it's trite and people use that analogy or metaphor. But I will tell you, as a developer, you will hear that very frequently. Oh man, if we just had this, it would sell, you know. And my philosophy, going back to Muskoka, and that's kind of why I talked about it, is that I never trust but verify, I guess is probably the best way to put it. And so in this case, it was, the reality was that buyers, so these are industrial condos. I should maybe just kind of discuss what that is versus just building an industrial building to lease. So each one of these bays would be about 1,500 square feet, and people would buy them and own them, right? A business owner would own them, not lease them. And so just like you would go in and buy condos in a condo building, you would buy these industrial condos. Okay. And what we found was the type of buyers that we were attracting could really only qualify for about 500,000. And so the reason that's important is because we had to, or what our business plan was, is that we shrunk up from 3,000 feet, which would have been a more economical build for us. We shrunk them down to 1,500 feet to be able to hit that price point, right? Because at 3,000 feet, 3,000 feet at about 250 to 300 a square foot, we would have been pushing up on $800,000 a door, not a door, but like a bay, okay? And like I mentioned, the experience from Muskoka, one of the other things that we found was that just because someone says they want to buy, right? When we were selling cottages, we would sell 8 to 12 in a weekend. And come Monday, you would have 4 rescind, meaning they wanted to cancel their offers. And so we expected that. We took larger deposits, and we really wanted to reinforce why this was a good investment. Oops. Okay, so we talked about it, 3 buildings, 24 condos. The land in this case was about 2.9 acres, 2.7 million, 925 an acre. Our total cost was about 9.5 million, and the exit was a little over 11 when it was all said and done. Okay, and it took us 16 months from start to finish. So in this, it was, I guess, this model that you're seeing right now, the club syndicate model, is really based on finding the right property, financing it with both equity and debt, and then optimizing or fixing. In our case, this was a development. Okay, so finding the opportunity. So the thesis, and this was an off-market property, is that the new tunnel that connected the Métis Trail to the airport would create demand for businesses in that area. We were driving around. In fact, my partner and I had another property that we were working on in this area, but we lost it to another developer. So we were already familiar with the area, and when we came across this other piece of land, which was at a very good location, Country Hills and 36th, we asked, would businesses locate there? If so, who? How much would they pay? And we talked to our agents, and they said, you know what? We feel that we can sell these. We said, okay, perfect. So the core assumption really was that you could hit the price point and there would be sufficient demand. Selling 5 condo bays there would not have been enough, right? We needed at least, I think it was about 70% to hit our financing threshold. And so what we did is we got control over the land. We tied it up for, I think it was 4 months. We spent a little bit of money on plans and architectural drawings and whatnot to be able to provide, well, here, I'll show you what we did, right? We put it under contract. We hired an architect. This was like probably iteration number 3. And this did not actually, like, I mean, if you look at the pictures, we never actually created this. And it was kind of goofy. I'm not sure why they did this. I think it was mainly to get as much square footage as possible. And we thought that there might be tenants for both of these, but it worked out that there wasn't. So we had to kind of continually iterate our site plans to accommodate what the market wanted. Okay, so we listened to what the market wanted. Just want to make sure that there's, I don't know if I can actually see questions, but let me just jump over here real quick. Nope. Okay, let's get back to it. Back to present. Okay. So the marketing material that we gave our agents, you can see here, we got some pretty renderings. And what I've noticed is some developers will kind of leave it up to the brokers to create the sales packages. And in my experience, because we were putting so much money into this deal, potentially, right, we did not want to leave it up to chance to have the brokers kind of creating the marketing material for this. So we, along with their help, we actually did the work and created it. We spent the money, we got these renderings done, we put the pitch, the investor presentation as well as the sales presentation to go out to these potential buyers. And at the end of the day, we were 70% pre-sold before we even remove conditions, okay? And so this is kind of just a page out of either the pitch deck, I think, and we also put it in the, no, I think this was the pitch deck. But you can see here, pre-sales created a sense of urgency and in demand. Step 2 is financing, both debt and equity, okay? Now, a lot of investors start with equity saying, how much money do I need? But I guess one of my first questions is, how much can I borrow? Because it's always going to be cheaper, not always, but it's going to be generally cheaper to borrow debt, especially from a tier 1 bank, than it is to borrow from, raise money from investors. And so we went to RBC in this case. And one of the things that I would just offer to people, and this is just my experience, is that if a tier 1 bank likes the deal, there's a good chance that they have vetted who the team is, the sponsor, they have vetted the deal, they have vetted the market, because these big banks are not in the business of losing money, okay? And so if they are going to lend money on a deal, on a development, they really want to make sure that this deal has a lot of the risk taken out of it. So just something to kind of consider. And so the flip side of that is you're getting high leverage from mezz or bridge lenders, and often, not always, but you know, these lenders, they call them kneecappers, and there's nothing wrong with it. But you know, when you're borrowing money at 10 or 12%, which a neighbor did in our near our development, I think they were at like 10%. They didn't have to go out and get pre-sales, so they thought that they could just build it and not have to worry about that. And what I will tell you is that the profit is in the last 10 to 15% of the deal. And so if you as a developer just kind of forge ahead, like what we noticed our neighbors who had started about 6 months earlier than us, and they finished 6 months later. And the challenge was that they just kind of went ahead with their plan without having feedback from the market. And when I toured their project, right, because you're always secret shopping. I know that people secret shop our developments all the time, and that's fine. That's just part of the game. I looked at it and I just said, like, and I took a successful commercial, industrial, both developer and broker through it. And he said, these are bowling alleys. Bowling alleys meaning long and skinny. And that, I think, hurt them. We found that out, right? It's cheaper what they did, but unfortunately, if you can't sell it, then it really doesn't matter. So like I said, we were able to secure a conventional loan from the bank because we were able to hit 70% pre-sales before we removed conditions. We were actually 100% sold out by the time that we closed on this project. Okay. Yeah, this was just, I think, the cover page. So you can kind of see here, this is one where like we were building 2 buildings. So this was like an L shape, and this would have been a goofy space, but we thought that we had a furniture dealer that was going to take like 8,000 square feet, which would have been tremendous, right? Because we would have increased the square footage and lowered the what's effectively called your price per buildable, right? And I'm not going to get into that right now. There's other videos I've done in the past on price per buildable, but that's basically what is the cost, what's the land cost as a percentage of the total overall development. So not going to get into some of these. These are just some of the things that we showcased. You can see here, you know, the location itself, what we liked. You know, we're really demonstrating demand. Okay, compelling reasons both on a macro and a micro level in terms of why this is a great and safe development. This is the acquisition timeline. I always like to include in an investor deck to visually represent what's happening now, first, second, third, right? So due diligence, it says 90 days. I thought we had 120. Probably by the time we put this together, we were 90 days left. Closing, I think we had 60-day closing, just going by memory. Construction, you know, we were pretty close on all of our projections. I think we expected it to be an 18 to 24 month period. We were able to execute it in 16 months. And then this is just your bio in terms of what you know, who you are, obviously our team, credible team with a proven track record. And then step 3, there we go, executing on the plan. So this is kind of the nuts and bolts of what a developer does. So we had weekly site meetings. We updated our LPs usually on every couple of months. We were talking to our brokers almost on a daily basis. We were talking to the bank every week, monthly tours with them. And one of the lessons that we learned, that I've learned and continue to learn as a developer, is what's called your QCS, your quantity cost surveyor. And this is the person that the bank hires to make sure. So let's say you go to the bank and say, we have the footings and the foundation and we're tying into the city and we've spent $1 million. The bank is going to send out their representative, the QCS, and they are going to verify that that work has been done in order to fund the project. And what I will tell you is there are many variables that go inside of a QCS or a QS report that if you have never done a project before, that you will find out very quickly the bank wants to make sure you have enough equity in the deal, right? They're going to want to see, have you accounted for GST? Have you accounted for brokers and commissions? Even if some of these expenses happen after the project is complete and developed, often banks are going to be overly cautious, right? What's your contingency? Are you carrying a 5% contingency on hard and soft costs, as an example? So there's all these variables that you can find out very quickly that if you run it, what is my one broker? He's like, if you fly too close to the sun, if you're right on the edge, if you will, oftentimes that's where you might have to kick in more equity as a general partner or as a partnership, however you structure it. So just something to think about. A few takeaways that I think would be important. So I guess, back to the 4 questions. So how much money goes in? 2.7. When does it go in? At closing, right, of the land. In our case, it was like 30 days prior. How much money comes out, right? In this case, it was about 1.3 million of gross before splits. And then when does the money come out? And it was expected in 18-24 months. The actual was 16 months. Here is kind of the experience itself. So the overall development, one of the things that I learned in Muskoka, like I mentioned, is I wanted to have backup offers, because the tendency is people are excited at the beginning and then they get into a deal. And if a person is buying to flip, they may back out. They may try to grind you. They may try to retrade you. And so I always want to come as a developer from a position of power. And so what that means is I have more than one option. Okay, so I'll just leave it at that. Number 2 is don't rely on your brokers to do all the heavy lifting. My partner and I, we met with, I would say, at least 50 buyers. I mean, that was our job nonstop. Ultimately, it came down to the developer really making sure and giving comfort. Like, let's face it, the brokers aren't the ones that are doing the project. They want to look at a developer in the eye and make sure that you're building a quality asset. Pre-sale, don't assume that you know the market. Meet with the buyers direct. Are they owners? Are they speculators? And not following the crowd. So this was something that I kind of learned after the fact. But what I would say is, and this is why frankly, I don't mind sharing this with you, because and there's a tendency for someone to see this and say, I'm just going to take this and apply it to my market, or I'm going to do the same thing Shane did, and I'm going to do it a mile away. Well, the reality in this situation is that as soon as people saw the price point and our development and its success, there's like 5 other developers. I think our agents even got into doing developments up there. So all of a sudden, developers saw success. They said, hey, we can go and make 7 figures on this project. And so what happened was hyper supply, not enough demand. And, there is all of a sudden just price compression on those type of assets when there's not enough demand and there's too much supply. Some of the mistakes, I've mentioned these, but I'm just going to reiterate them, and they are being greedy, right? Over leverage with expensive debt. Delays, cutting corners on the team with a cheap architect. That's going to cost you in time, in cost overruns, change orders. Number 3 is unknown costs, right? Making sure you have a healthy contingency. As an example, there's a concept here in Calgary called a degradation fee. And we didn't experience this until about 10 months into the project, and we get jammed with like I think it was $75,000 or $90,000. Now, we had enough contingency, it wasn't an issue, but no one likes to, get hit with something that you just didn't expect. And that degradation was to dig into the roads, to shut down the roads, to have the city come out and inspect, etc. So you learn that now in every one of my pro formas. I always account for that. Design, don't assume your architect and GC are on the same page. This is where having pre-construction involving a general contractor early on in the process as possible is important, in my experience, and being transparent. One of the things that I think shocked a lot of people, and probably even for some people watching this, is how transparent I am. I'm not transparent to the extent that I'm going to be stupid and share deals or things that I don't want, potential competition to see. But what I explained to all of the buyers was, because they were comparing our project with one right down the street with one across the road. And I said, look, we're not comparing apples to apples here. These other projects are building in mezz space, right? So in these industrial complexes, you can build second floor office. And I said, it only costs $80 a foot to build that. But you're saying the square footage of that unit over there, which the base box is the same, but you're layering in another 800 square feet as an example. And you're saying that they are $30 a square foot cheaper. Well, if I bake in an extra 800 square feet, I build it at $80 a foot, and then I show them the math, we're actually 20% cheaper. And so you just always want to make sure that you understand the competition, you want to be transparent, and you just want to educate your buyers, because they didn't know that was how the numbers were being calculated. Okay, I think that's it for right now. I was going to go into the townhouse development, but I'm at 36 minutes. It's kind of gone long enough, and I'm just going to see if there's anything else. Let me just get into some of the takeaways here. If it'll go to that. Okay, here we go. So in summary, there are a few keys that I think are important, whether you're a passive, active, passive investor, active investor. Passive being in someone else's deals, active your own deals. We talked about developments, but they could be value add properties. And really what I think I want to emphasize here is focusing on properties that meet your investing criteria, okay? Both in risk tolerance, timeframes, and experience. And obviously capital, right? You don't want to get into a deal that you don't have enough capital to be able to see it through. Number two is understanding the risks and really knowing what questions to ask. So who's the sponsor? How much debt? What are the assumptions in the pro forma? Let's stress test them a few different ways. What's the property itself, the market? We talked about those 7 variables at the beginning. Number 3 are, what are the key assumptions? So this would be the supply and demand fundamentals. What is driving the success of the investment? And like Sam Zell asks, what is the key assumption that must be true for this investment to be successful? I almost feel like if you just ask that question and you ask it over and over, because sometimes the key assumption is that we can get the zoning, right? So for example, on this townhouse development, even though I'm not going to go into it, one of the assumptions was that we could get a certain density. Let's call it 24 UPA. UPA is units per acre. So if we can hit that, now the next question is, okay, how much is it going to cost to build? So we have to be able to build it for, in our case, under $300 a door. Okay, that is the next key assumption. And then the next assumption after that is that we can rent it out for $2,000, $1,800, whatever that number is. So you can keep asking those assumptions, keep testing it until you get right down to, a deal that you feel comfortable moving forward on. Or you say, you know what? The key assumption that needs to be true, I actually can't get comfort with it, and therefore I have to walk away. And then the last is asking the 4 questions that you need to get answered. How much money goes in? When does it go in? How much money comes out? When does it come out? If you're putting money into someone else's deal, if they can't answer that basic those questions, then I would have a serious concern as to whether or not they are the right person to invest with. Okay. And yeah, so this was, as you can see, this was literally the presentation that I did. You probably already, if you're listening to this, you're already on the podcast. If you were not aware, you can get a copy of my free book at my website, shanemelanson.com. In addition, if you want to buy the book, people say, why do you give it away if you can buy it? Well, if you buy it, then there's probably, I don't know, $300 worth of bonuses, whatever you want to call it, free training, additional videos, pitch decks, all that kind of stuff that you can see, and it's for like $7. So if that's something that you wanted, you can certainly do that. If not, then by all means, just download the free copy at shanemelanson.com. And that is what I had for today. Thinking about doing, let me just stop this. I'm thinking about doing, I don't know if I'm going to do it on a weekly basis or maybe a monthly basis, but sort of like in this group, in the Facebook group, kind of an Ask Me Anything, where you can come in, ask questions. I don't know how to do it in a live setting in the sense that you could actually come on, but you might be able to type in the questions and I'll do my best to answer them. So if that's something that would be of interest, let me know. You can, go to the Investing Advantage private Facebook group and post in there that, yes, I would like that opportunity, Shane. Just with the new developments that I have, we literally put another one under contract just before Christmas. And so I think I've got about 5 developments on the go right now. So as I get busier, it'll be harder for me to do kind of one-on-ones, but the plan is that I'll be able to, see, someone just give me a thumbs up. I appreciate that. The idea is that I still want to be able to support and give help where I can. And so I'm thinking that this might be a medium to be able to do that. And so that's really what I've got. I think I might do next week, I might get into the planning that I'm doing for 2022. And the reason I'm putting that out there, just so you know, is that it forces me to now document and really think about how I'm going to plan for next year, at least for the next 3 months. It's usually how I plan things now in 90-day chunks. And so if that's of interest, tune in to next week. And then I've just got I've got some awesome guests lined up for 2022, so I'm super excited. And anyways, it's been a great year, 2021. It is December 30th at 2:22, and I am going to go. It is finally nice enough in Calgary. I'm going to go for a nice run. I don't know how long, maybe just 4 or 5 miles. But anyways, I appreciate you tuning in, listening. The feedback has been great, and sometimes even if it's not great, then helps me to be a better educator, presenter, whatever it happens to be. And so I appreciate you, and hope you and your family have a tremendous end of 2021, and look forward to 2022. So that's it. Bye for now. And if you like this, share it with someone. Hopefully they will get value out of this. Like I said, this is really just to hopefully help and educate you into how I think about deals. And if it works for you, that's great. If it doesn't, then, hopefully you got something. Bye for now.